Wealth is an illusion built entirely on collective belief. The moment that fragile, invisible consensus fractures, the world simply stops. Fortunes vanish into thin air, empires of commerce crumble, and the very fabric of society begins to unravel. We perceive modern economies as unshakable fortresses of mathematics and logic, yet they are fundamentally driven by human emotion, hidden risks, and invisible dominoes waiting to fall. These are the top 10 hidden causes and effects of major financial crises. Number 10. The phantom wealth of speculative bubbles. It begins with a whisper of unimaginable profit, a new asset that promises endless riches. Throughout history, speculative bubbles have seduced the masses, convincing rational people to trade their life savings for assets with absolutely no intrinsic value. From the Dutch trading away massive estates for a single tulip bulb in the 17th century to the frenzied rush for internet domain names in the late 90s, the historical pattern remains completely identical. The mechanics of this phantom wealth rely entirely on the greater fool theory. Buyers purchase overvalued assets not for their utility, but with the absolute certainty that someone else will buy them for an even higher price tomorrow. This creates a self-fulfilling prophecy of rising prices, generating immense paper wealth that feels incredibly real to those holding it in their portfolios. But paper wealth is merely a ghost. When the pool of greater fools inevitably dries up, the illusion shatters with terrifying violence. The resulting panic destroys capital at an astonishing speed, wiping out decades of savings in a matter of days and leaving behind a devastated landscape of bankruptcies and ruined lives. Number 9. The domino effect of banking failures. Behind the heavy vault doors and marble facades, a terrifying reality exists. Your bank does not actually have your money. Modern institutions operate on a fractional reserve system, meaning they only keep a tiny percentage of customer deposits on hand, lending the rest out to fuel economic growth. This system works perfectly, right up until the exact moment everyone wants their money back at once. A bank run is an exercise in pure contagious terror. It often starts with a mere rumor of insolvency, prompting a few anxious depositors to withdraw their funds. As lines form around the block, fear spreads like a virus, transforming a baseless rumor into a fatal reality as the institution rapidly drains its limited cash reserves to appease the growing mob. When one institution falls, the shockwave violently strikes its neighbors. Banking failures are rarely isolated incidents. They act as the catalyst for systemic collapse. As credit lines are abruptly severed and interbank lending freezes out of mutual distrust, even healthy institutions are dragged into the abyss, turning a localized panic into a nationwide catastrophe. Number 8. The illusion of risk-free debt. Wall Street has long sought the holy grail of finance, a way to transform highly dangerous loans into supposedly safe investments. This financial alchemy was the dark heart of the 2008 housing crash. Investment banks gathered thousands of risky loans, specifically subprime mortgages given to borrowers with poor credit histories, and bundled them together into incredibly complex financial instruments. Through a convoluted process of financial engineering, these toxic bundles were stamped with pristine credit ratings, masking their true danger from global investors. Pension funds, foreign governments, and institutional investors eagerly bought these seemingly risk-free assets, unknowingly injecting a lethal poison directly into the veins of the global financial system. When the initial borrowers inevitably began to default on their homes, the entire house of cards collapsed. The revelation that trillions of dollars in supposedly safe assets were actually worthless triggered a catastrophic loss of trust. The resulting implosion nearly destroyed the global economy, proving that masking risk does not eliminate it. It merely concentrates it into a devastating explosive. Number 7. The invisible web of global interconnectedness. A defaulted loan in a small American suburb can bankrupt a municipality in Norway. This is the terrifying reality of modern financial contagion. The global economy is a hyper-connected nervous system where capital flows across borders at the speed of light, binding the fates of nations together in ways that are entirely invisible to the average citizen. During a crisis, this interconnectedness transforms from a strength into a fatal vulnerability. Financial derivatives, originally designed to hedge risk, act as high-speed transmission cables for panic. When a major player stumbles, the complex web of counterparty risks ensures that their failure instantly threatens institutions oceans away, turning localized rot into a global pandemic. Governments repeatedly discover that national borders offer absolutely no protection against financial viruses. The speed at which panic travels through digital trading networks vastly outpaces any regulatory response. This invisible web guarantees that the next major crisis will not be contained, but will instead echo through every market on Earth simultaneously. Number 6. The psychological trap of irrational exuberance. Markets are not cold, calculating machines. They are manic depressive engines driven by human psychology. The term irrational exuberance perfectly captures the collective delusion that takes hold during a massive economic boom. Investors begin to believe that the old rules of economics no longer apply, convinced that a new paradigm has been reached where prices will only ever go up. This psychological trap is fueled almost entirely by the fear of missing out. As neighbors and colleagues boast of effortless riches, the social pressure to join the frenzy becomes overwhelming. Rational analysis is discarded, replaced by a desperate, greedy stampede to acquire assets at any cost, blinding participants to the glaring warning signs of an impending crash. The hangover from this collective euphoria is brutal and long-lasting. When reality violently reasserts itself, the psychological whiplash from extreme optimism to absolute despair paralyzes consumer spending and business investment. The emotional trauma of the sudden loss often inflicts deeper wounds on the economy than the initial financial destruction itself. Number 5. The silent erosion of regulatory oversight. Disasters of this magnitude rarely strike without human assistance. Over decades, intense lobbying and political pressure often lead to the systematic dismantling of the very guardrails designed to prevent economic catastrophe. Government regulation is frequently painted as the enemy of growth during prosperous times, leading to a dangerous amnesia about exactly why those rules were created in the first place. As oversight quietly erodes, financial institutions are unleashed to take on massive, hidden risks. The separation between boring, everyday commercial banking and high-stakes investment banking is blurred or erased entirely. This allows speculators to gamble with ordinary citizens' deposits, knowing that the potential profits are theirs to keep, while the catastrophic risks are quietly passed on to the public. When the inevitable collapse occurs, the lack of regulatory visibility leaves authorities completely blind to the true scale of the rot. Regulators find themselves desperately trying to extinguish a raging inferno without knowing where the highly flammable toxic assets are hidden, proving that deregulation often merely delays the bill until it becomes too massive to pay. Number 4. The sudden evaporation of liquidity. Credit is the invisible oxygen of the modern economy. Without it, the machinery of commerce suffocates almost instantly. A hidden, terrifying effect of a major crisis is the sudden absolute evaporation of liquidity. In a climate of extreme fear, banks simply stop lending to everyone, including each other, aggressively hoarding cash to ensure their own survival. This invisible freeze has immediate, devastating consequences on Main Street. Healthy, highly profitable businesses suddenly find themselves unable to secure the short-term loans required to make payroll or purchase inventory. Supply chains grind to a halt, ships sit idle in ports, and factories fall silent, not because there is no demand, but because the financial lubricant has vanished. The evaporation of liquidity transforms a Wall Street problem into a global unemployment crisis. As businesses collapse from cash starvation, millions of workers lose their jobs, further depressing consumer spending and accelerating the downward spiral. It is a stark reminder that the continuous flow of money is just as critical as the money itself. Number 3. The generational scarring of the Great Depression. Some wounds run so deep they permanently alter the DNA of a society. The Great Depression was not merely a severe economic downturn, it was a traumatic event that permanently rewired the psychology of an entire generation. The sheer scale of the suffering, with massive unemployment, breadlines, and the total loss of life savings, instilled a profound, lingering terror of financial ruin. This generational scarring manifested in deeply ingrained behaviors that lasted for decades. Survivors of the era became famously frugal, hoarding cash and mattresses, obsessively repairing worn-out goods, and harboring a lifelong distrust of banks and credit. The trauma created a hyper-conservative approach to personal finance that they passed down directly to their children. Even on a macroeconomic scale, the echoes of that dark decade dictated policy for half a century. Governments built massive social safety nets and strictly constrained financial markets, driven by the collective vow that such widespread destitution must never be allowed to happen again. The ghost of the 1930s fundamentally shaped the modern welfare state. Number 2, the unintended consequences of bailouts. When the abyss stares back, governments are often forced to intervene to prevent total societal collapse. But rescuing failing institutions introduces a toxic concept into the economic ecosystem known as moral hazard. By deploying taxpayer funds to save banks that made catastrophic, reckless bets, authorities inadvertently send a highly dangerous message to the market. This dynamic effectively privatizes profits while socializing massive losses. Executives and shareholders reap enormous rewards during the boom years, but when their high-stakes gambling triggers a crisis, the public is forced to absorb the devastating cost. It creates a perverse incentive structure where institutions realize they are simply too big to fail. The long-term effect is a deep, festering resentment among the populace. Bailouts save the immediate system, but they fundamentally fracture the social contract. When millions lose their homes and jobs while the architects of the disaster receive government rescues and massive bonuses, it breeds a cynical distrust in institutions that can destabilize political systems for generations. Number 1, the permanent transformation of how we view money. Every catastrophic crisis fundamentally shatters our understanding of value itself. Money is not a physical law of the universe, it is a shared psychological construct. When a major collapse destroys wealth on a planetary scale, it forces humanity to completely renegotiate the terms of this collective illusion. Historically, these renegotiations have birthed entirely new financial paradigms. The devastation of the 1930s led to the creation of the FDIC, fundamentally altering the relationship between citizens and their banks. Later crises contributed to the severing of currency from the gold standard, transforming money from a physical commodity into a pure abstraction backed only by the faith in a government's promise. Today, the fallout from recent systemic failures continues to drive the search for alternative systems of trust, fueling the rise of decentralized digital currencies and challenging the absolute monopoly of central banks. The ultimate hidden effect of every financial crisis is that it forces us to look at a piece of paper or a number on a screen and ask the terrifying question, what makes this worth anything at all?